Hello, everyone, and welcome to our webinar this afternoon. We have Florence Magee with us today, and Florence has been imparting very important and pertinent information to you on previous webinars. And today we're going to look at everyday finance for craft and design, the second part, in which she's going to explore key terms and concepts for financial planning and reporting. So, as usual, if you could put your questions into the chat box, if there are matters of clarification, I'm sure Florence will answer them as we go along. But in the main, let's keep the questions to the end. And with that, I'd like to welcome you, Florence. Thank you for being here today.
Thank you, Emer. Thanks for having me again, and welcome everybody. Today we're going to talk about finance for craft and design businesses. And due to demand, we're going to look at really the key terms and concepts that you encounter when you run a business like this. Okay. So with this webinar, what I wanted to do is really to demystify the terms because it's all accounting speak, but it's very much what you're doing during your daily life. I want you to understand the main points of contact with finances in your year would be your tax return, would be you setting your prices, and would be doing your general reporting for yourself. You're checking how things are going. So I've looked at the main calculations that you need for your tax return, but then I looked also at your cost and how this is important when you're going to set your prices, have a good understanding of how your business is set. And we're going to talk a lot about profit and how profit is created in the business, how it flows through the business, and what it comes out as when you do your tax return. Really what I want to give you is a confidence in understanding your financial terms, how it's created in your business, and the potential you have to develop a strategy that really works for you. So just as a little warning, I've taken the tag that you are operating as a sole trader. So you're not registered as a company because it gets a bit complicated. There's also a lot of things that I've left out because we only have 40 minutes and I don't want to just, go down the accounting rabbit hole with you. It wouldn't be useful. Right, so I've divided the webinar in really three parts. First and foremost, we're going to look at what you come up with for your tax return, particularly for the trading element, so reporting what you've done during the year. And hopefully that will demystify a lot of the terms. Then we're going to look at the pricing and how that is created to create profit in your business and the different terms that are used. Sorry about that. And then we'll finish off with a little understanding of financial performance, what it means, what you should be doing or whatever, but so that you can, know what it means for your own business. There we go. Before we go any further, to introduce myself for those who don't know me, my name is Florence Magee. I am a creative industries trainer and mentor, and I have a background in business. I've done an MBA in creative industries management, focusing on business support, but I also was a hand weaver for 5 years. So I have the experience of, as you can see, being at a fair and setting prices and trying to, work it all out. As you can hear, I am French, but I've been based in Ireland since '98, with some time in the UK in the middle. Right. So just to reinstate why it is important understanding your finances. And I've done a previous version of this webinar. The part one was really understanding what are the figures in your business that are important, how they come about, and how you can start planning and doing your budgeting. So it's really important to know your figures on an ongoing basis because you want to make sure that you're operating sustainably. You want to, reduce any stress linked to finances or tax returns. You want to be able to make decisions that are based on facts and that will benefit your profits and your business in the long term. You want to make sure that you can plan for putting money aside for your investments, your taxes, but also to pay yourself. Very important. Most people have a once a year way of looking at their finances. When I say most people, it's where you start in general. You put your receipts in a shoebox and then you tally them all at the end of the year and you try and do your tax return. So what's that not going to give you is an ongoing view of how you're doing. How far are you off your goals? Are your material costs increased? Or it doesn't give you very much information, and you cannot see issues arising. So you cannot see when you're going to have an issue with cash flow, of something is just going to come your way that's going to throw really a spanner in the works. Also, you can't spot the positive things, the trends, or just have a closer look at how your business is behaving. And then you need to be able to know how much you can, pay yourself as you go along, so that you don't take a big lump sum at the end of the year. And then you need a bit of savings for your taxes and maybe for investment next year, should you do a trade show or get some equipment. Right. So first, for our part on the tax return. And really, I'm not going to go too deep into it, but it is very much, the big financial thing that we all have to do once a year. And if you have not working with an accountant, or if you want to understand deeper what your accountant is doing, it's a good way to start. Okay, so that's going to be a bit more technical, but again, I'm not going to go too deep into it, and we are going to look at examples. I think it's very important that you understand how those terms relate to yourself trading, selling at fairs, selling to shops, how that's going to work. Okay, so there's two main financial statements when you are a sole trader, and they don't need to be filed anywhere. That's the same for small companies. They would be totally the same. There's what's called the income statement, and that's the profit and loss. And you might have heard about this term. It's basically, it tallies how much you sold and how much you spent and what's left at the end. That's really the, and we're going to go through this one a bit in detail so that you understand where the different terms come from. And then there's what's called the statement of financial position, and that's the old school balance sheet, and something we're a bit less used to. The balance sheet tells you at a point in time how much the business is worth. So when the business is yourself and you're not intending to sell, it may be less important, but it gives you a sense of how much you own, which is your assets, and how much you owe to maybe the bank or to creditors that you haven't paid yet. If you have invoices you haven't paid, that's called your liabilities. And I'm not going to go too much into the balance sheet because it comes at the end of the tax return, and you kind of really need to be a tax accountant to really go deeply into it. And that would be way over 40 minutes. Before we start looking at the scary revenue sheet, I would like you to really understand how the profits are stacked up in your business, because basically my goal is for you to make as much profit as possible, for the sole reason that your profit, if you're a sole trader, is how much you're going to pay yourself. So at the end of the day, this is the figure that is really important for me, is how much do you manage to pay yourself. If you can't pay yourself, you're not going to be sustainable. You're not going to be able to continue your business for very long. So looking at our little threshold doors there, we have the sales coming in, and I'll go deep into each of these doors, but the turnover. Then we go down to the gross profit, then we go down to the net profit. And that will make sense in about 5 minutes. But what I want you to understand now is that net profit is what you're going to pay yourself after adjustments and taxes, it is your take-home pay as a sole trader. So it really comes at the end of that whole process of paying the bills, paying everything. That's why you kind of would need to have an idea of how much that's going to be throughout the year so that you can have drawings. And drawings, it's the name for what you pay yourself as a sole trader. If you are a company, you would pay yourself a salary, and the salary would be an operating expense. And you'll understand what that means in a second. And then you would pay company tax on profit. So the structure is different. And then one important thing to say, and we'll look at both, is that when we calculate costs for the tax return, it's a bit different from putting your costings together for your prices. And understanding where that differs will be very important. Okay? Right. Now the scary form. This is the Irish revenue, Form 11, which is basically where you tell them these are extracts of your accounts, and that supports your reporting a net profit or a net loss. So I'm not, as I said, not going to go into all the adjustments that can happen. The adjustments might happen when you've done what's called a capital expense. So you've purchased a large piece of equipment and you're gonna what's called depreciate it, which is attribute the money over several years. So I'm not gonna go into it. I'm just gonna go into your trading account, which is the money's in and money's out. So to understand the big principles of doing your accounts is that we're only looking at the income and the expenses for that financial year. And it's very easy to understand like this, but it means that you must take off the expenses that you might have received for something that you're gonna sell or ship the next year, for example, if you received advance payment. And also you spent money on stock and making products, but you're not going to sell it until the next year, and that should be adjusted as well. So we'll see a calculation for that. And then when you do your taxes, you need evidence for everything. So evidence for money in, evidence for money out. So all these receipts, you keep them, the invoices, you keep them for 7 years. Now, our first, so to go back there, I'm going to look at this line, which is your gross trading profit. So what does that mean? It is your turnover minus the cost of goods sold. It's still financial speak, I'm sorry. And to make it even scarier, I can give you the help from the manual from the revenue. If you try to do your taxes, it's the gross profit of your business after adjusting for opening and closing stocks and input costs. That is not very clear. So we're going to go through it and you'll see that you'll have a very clear understanding of what that means very shortly. So first thing is your turnover. Your turnover is called your sales, it's called your revenue, your receipts. It's what money that's come in for your services or your products, but very important not to call it income or profit because that will muddle the issue in your head. Then your purchases is your direct cost, is what you purchase to create your products or to directly produce your services. It's linked to a product and it's per product. It could be the materials, the raw materials, consumptions, outsourced labor, if you're paying somebody to make the work, the packaging, all these things you should have a cost per product. So it's called a variable cost. And then, so that was the turnover, and then the cost of goods sold. It's called cost of sales as well. And we generally use just the purchases, what we just spoke about, that's variable cost. But the full equation is to actually adjust it for the variation in stock. So there's some stock that you had at the start and some stock that you had at the end. And we're going to do an example. The value of your inventory is actually the direct cost. So it's not taken by the retail price. It's the direct cost of the materials and whatever went into the making of the product. And you can have an average. So all the direct costs divided by all the products. We'll do an example. Okay. So now we're narrowing down from our gross profit to our smaller doll of the net profit. So we've taken the turnover, we've taken off what it costs to produce the works, and now we're going to look at what's called operating expenses. And that's going to give you your net profit. So the net profit is that gross profit, what's left after paying for the materials and what it costs to produce, and then taking off what it takes for the business to run. So operating expenses has different names, but it's your overheads. It's what you would pay if you would not sell anything or produce anything. It would be your studio, it would be your, your light, your electricity, motoring expenses, just any subscription you have, your equipment that you need to work with. But it has, just make sure that you know it has different names. If you're using your telephone, your Wi-Fi, electricity in your home for your business, you can apportion the bill that you have for your house to the amount that you use for your business. So that if your studio is 10% of your house, you take 10% of the electricity bill. But all this should be written somewhere so that you know what your rationale was next year, and the year after. Right. Now we're going to do a little example. It's the same with a guy that we met in part 1 of this series. And just to refresh your memories, or for the ones who weren't there before, he's weaving away and is selling directly his scarves at 100 euros per scarf. His direct cost per scarf is 20 euros, and he produced 300 scarves the previous year and sold 240 at Christmas. So it means that he has 60 scarves left in his stock. He started the year with 40 scarves. We also know that his overheads are 6,000 a year. So now we're going to look at his tax return for January to December. So his sales are 24,000, 240 scarves at 100 euros. And then we're looking at the cost of goods. So his purchases are his material cost, the direct cost times the 300 scarves. Then we take off that variation of value of stock. So it's just 40 scarves at the start at 20 euros. And we know he has 60 scarves at the end at 20 euros. We've removed that. So instead of having a cost of goods sold or cost of sales at 6,000, it's a bit less because he has some in stock. He hasn't sold them during that financial year. So the gross trading profit is 18,400, right? And now we're going to whittle that down to the net profit by taking off what it cost him to run his business. And we know that's 6,000. So I've itemized it here as kind of a reasonable expense for a weaver. So that's professional, he's paying an insurance, he's gone off to see showcase, he has a studio that he pays every month for utilities, all these things. And that gives us a net profit of 12,400. After that, you would have what's called adjustments, and I said I wouldn't go into that because it takes some balance sheet items to narrow it down to the net adjusted profit, but that's what he would pay his income tax on, those 12,000. And that's, that is what he would report to the revenue. Okay. So I hope that was not too complicated. We'll actually come back to it at the end, because now I want to look at prices. And I know it's quite a jump from tax return to prices, but these are not separate in the business, because the prices that you set will create the profit that you will then report to the tax revenue. So it's really looking at the systemic view of how you take decisions in your business and how they affect how much you pay yourself. Right. Pricing is a huge issue, a subject anyway, and it can make or break the business. but also there's a huge amount of formulas or whatever around. So trying to find what works for you is very important. And it's a good thing to remember that it is a negotiation and it is a balancing act between your needs as a business to cover your costs, to pay yourself. If you're selling to trade, to shops, their markups, and then the market price for the product and what is expected. And what is the market price is a positioning question, and you can change that. But there is, in general, a certain level at which you're expected to sell your goods. And the retailers will definitely tell you whether it's too much or doesn't, too little. Right, we're going back to our Russian dolls so that we can really understand, again, how profits stack up. And we're going to go through all of these. But the little one is how much it costs you to produce your goods. When you sell to trade, your trade price, this is how much you make as a business for your profits. Your retailer will sell it at the recommended retail price, the RPP, and they make a profit on it. If you sell your goods directly, then of course your profit is much larger. And we'll have interesting examples there to see how you can play with those margins to really maximize things for yourself. So when you do your costings, it's very important that you actually understand how much each product costs to produce. And I said earlier that it's a bit different from your tax return. And the main reason there is that you don't invoice yourself. So you wouldn't actually evidence a payment to yourself as a laborer if you produce your own goods. If you use outsourcing, of course, you will have the bills for it. Okay, so your price should cover the direct costs, as we said, the materials, the consumables, the direct labor, a percentage of overheads, so each product helps pay for the cost of running the business, a bit of the taxes that you will pay at the end, a bit of profit for future growth, and maybe a contingency for discount if you're going to do volume discounts. That's a lot to cover in the price. Okay. You probably have done some research on pricing formula and how's that working. And this is the formula that most people seem to use, which is taking your full costings plus a bit of profit, multiplied by 2, and that's your direct price. The retailers apply a markup of 2.5 to 2.6 for accessories and fashion, and that gives you the retail price. So the retail price should be the same for you and for the retailer, which means that there really is a squeeze on that amount of profit that you can have, when you sell directly to trade. Your prices should be worked out per product, and they really should benefit you over the whole range. And they should work for you, they should work for the retailer. So we're going to look at an example. It can be very difficult. We're going back to our weaver guy. So he's been selling direct, and now he wants to start selling to trade because he's doing really well. As we said, he's produced 300 scarves last year, and we know that they cost him 20 euros per piece in material and direct cost. He also knows that it takes 1 hour per scarf to produce and finish. And we know as well that the business takes 6,000 euros a year to run. So very quickly, I can see that he has made an error basically in his pricing, and how, because he was selling directly, he, let's look at the formula and I'll talk you through it, and you'll see for yourself where the problem comes. So the retail price is 100 euros, which is quite expensive for a scarf. And he had multiplied his direct cost by 2 to give a trade price if he were to sell to trade, and then time 2.5 for a retail price. So it gives us 100 euros. If we really look at the full costings, we have a cost price for the scarf, not of 20 euros, but closer to 60 euros. And this is divided by the direct cost of 20 euros, the share of overheads, which is the overall total overheads divided by the amount of products, and then his labor cost, which I've costed at 20 euros per hour, which is actually quite low. If he were to sell to trade at that cost, he would have to sell to trade and then update his retail prices. He would have to have a recommended retail price of 312. So that would be quite a lot. Actually, that would be well above market prices, and it wouldn't work for himself, but it wouldn't work for the retailers as well. So it's a situation that happens a lot when you want to start selling from selling direct to selling trade, right? If we do a reverse calculation and we take a recommended retail price of about 125, it would give you a retail price of a trade price, sorry, of 48 euros if you put that 2.6 markup. Can he survive selling at 48 euros? It's actually below his total cost. And if we don't take his labor as a cost that is going to actually pay out, it gives him a profit or labor cost of 8 euros. So he would earn just over 2,000 euros per year selling at trade, and it's not sustainable. Okay, so what can he do? First, he can start working on his direct costs, so reducing the cost per product, spending less time on it. Okay. Then he can try lower his overhead, working on the overall bill per year, maybe renegotiated some of the contracts or buying in bulk. Oh, sorry, buying in bulk is for the previous one. He can produce more to actually have a lower overhead per product amount. He can try and reduce his inventory a little bit to reduce that cost of goods sold. He can try and increase his income by increasing sales or bringing in money that doesn't mean extra production, like teaching or actually subletting his studio when he's not using it. Or he can change his sales strategy, decide he doesn't want to sell to trade, or maybe limit the amount of sales to trade to a certain percentage. Or he can develop a new line of products that is more profitable. Right. So I've given him a new strategy. He's decided to revise his costings and to change his sales strategy from a direct sales strategy to not a fully trade indirect sales strategy, but half-half. So he's lowered his direct cost to 18 euros per scarf instead of 20 euros, which is pretty good. He's increased his production to 450 scarves per year, and he's increased his retail price to his clients and in the shops to 125. It's 25 more than what the client was paying. It's still reasonable. He's decided to sell to trade, but to limit it to 50%. So that it doesn't do more than that. And also he has managed to increase his sales to 90% of his production. It was 80% before. So it's taking care of a bit of the stock, and it means that he will have sold 405 scarves that year. Okay, so how is that working for him? And we're gonna go back to, well, doing a tax return for him. First, we're gonna look at the costings and how much that is. So direct cost, 18 euros per product. Labor cost, I haven't changed that, 20 euros. The overhead has decreased because there's more products to carry that burden of 6,000 euros. So the total costings for one scarf, 51 euros. Okay, it's still more than what trade would pay for it, but it's decided to actually sell at a slight deficit to trade to actually make the volumes. So he's selling half of his production at, well, 3 euros per scarf under his costings, and half of his production at 125 euros, which is 74 euros of profit per scarf, which is more than what he was selling it at before. And the total turnover is just over 35,000, which is quite subsequent, more than 24,000. Okay, so we do the same calculation as we did last time for its profit and loss. We have its turnover. Now we take the purchases and we adjust for the variation in the inventory, that is the value of the stock at the start, which I've actually accounted for the current direct cost, so 18 euros per scarf, 60 scarves at the start, 105 scarves at the end. So cost of goods sold, 7,290. We deduct that from the turnover. That's our gross trading profit, 27,781. We take off the operational expenses, the overheads, and that gives us the net profit with the own labor of 21,781. What we did in the costings is that we included his labor cost in the costings so that we didn't leave that to the final calculation at the end, hoping that something would be left to pay himself. He squeezed that a little bit when he sold to trade, but there was still an element of paying himself in each product. And that's why it's quite important to do your costings for pricing separately from doing them looking at your tax return at the end, because that element of net profit at the end should be distributed through each product when you sell directly or when you sell indirectly to trade. So with this version, is done 75% more profit, more income at the end of the year than selling to directly to customers. Okay, I'm going to wrap this up with a little looking at margins, and it's financial talk, but I'm going to show you why it's important. Okay. So your margins, it's again, business talk, and in some sections, it's very important. But really, margins are important for yourself as a business owner to understand how your business is faring. They're only important in relation to your activity and your strategy. And a margin in in isolation of what the business is doesn't mean very much. Like restaurants generally have margins of 3%. It's quite low. It's just they have very high volumes. So margins, they really allow you to look at your business quite closely and see how it's comparing between the years and point out where issues might be. Just as a rule of thumb, while I said that they're only relating to you, generally, if you produce, the less you produce, the higher your margin must be, because your income will be your margins times the sales, the volume of sales that you have. So if you have very few sales a year, your margin should be high enough that they allow you to bring your profit in. Okay, so two types of margin. The first margin is relating to that gross profit. So that profit at the start, where we've just taken our sales and deducted how much it costs to produce the products. And it's just division, gross profit divided by turnover, multiplied by 100 gives you a percentage. And basically it shows you how much of your sales are taken up by producing that item. And it might point you in the direction of needing to reduce your raw materials, or knowing that you should increase the level of sales, or if it's not much, then once you take off how much the business costs to run, then it's going to be even less for your profit at the end. So having an idea of what's a good gross profit margin for yourself is a good thing to know. Right. Then finally, your net profit margin is how much of your sales ends up at the end as a profit in your pocket as income. So the net profit, again, is a division, and it's influenced by how much your business costs to run. So how much you're spending on your studios, on your utilities, on everything. If there's a lot going to that net profit margin, a big difference from the gross profit to the net profit, well, you might want to look at maybe renegotiating contracts, or, as I said, subletting a bit of the studio, or just squeezing down a little bit so that more can come to you as a business owner. Right. oh, sorry, it's a bit squeezed, but it's the weaver's profit margin. So just to wrap it all up together, I've taken our two scenarios where he sells direct at the start, and then where he's decided on a combined strategy of 50% direct, 50% trade with a revised recommended retail price. And we can see with the selling direct, his gross profit margin was 76%. So 3/4 of his sales were gross profits, pretty good. And then taking off his business expenses, we went down to a net profit margin of 51%. So let's say half. So for every euro value sold, 50% comes in his pocket at the end of the year, which is very good to know. With the combined strategy, the gross profit margin increased to 79%, so a good 3 points increase. And his net profit margin increased to 62%. So actually he made more money. The reason for it is that he produced more, so his overheads got diluted, let's say, with the amount of products that he sold. So he didn't spend so much on his overheads. Right. I'm going to leave you with this understanding of where your profit margins, why is it just for vanity for yourself? Where is it important? And basically, when you're starting, having an understanding of how your net margin is, or the region of it, will be important to know what type of turnover you can expect. Because if we have, let's say, a net margin of 60%, like we saw for the last scenario for the weaver, to earn 20,000 euros in your pocket, which is, it's not a lot, but a lot of people would be happy to earn that as a maker, you'll need a turnover of 33,000 a year. If the net margin lowers to 50%, which is still very high, you will need a turnover of 40,000 euros, sorry, for an income of 20,000 at the end. And then if your net margin is 30%, then you need a turnover of 60,000 euros for an income at the end of 20,000. And I must say, looking at a lot of businesses, it's actually the latter that I see a lot of a net margin of 30%. So it's good to have a look at what's yours, how you can make it closer to 50% or as high as possible. Right. So just to wrap it up, because I know it's been quite intense. We looked at the turnover and what that is and how it's going to be reported on your tax return. We looked at the direct cost and the overheads and how that gets reported at the end of the year. We calculated our gross profit, our net profit. Then we talked about costings in a different way than reporting for the costs for the year, as costings for pricing and how it's important to include an element of labor in your pricing. We also saw how it's important to have a profit and strategic view on pricing so that you are able to go from selling direct to selling to trade. Also, you know how much each sale will bring you as a profit. We looked at strategies for reducing costs when our example wanted to start selling to trades. And then we finished off looking at margins, looking at the gross profit margin, the net profit margin, what that means and how that relates to your income at the end. And really my goal for this very short presentation to a big subject was to show you how your income is generated through your choices as a business owner throughout your business and throughout the year. That is it. Thank you very much.
Florence, you have just made in 37 minutes an extremely complex set of principles, very, very clear. And I would agree with you. You were saying that of the businesses you see, most of the craft businesses I would see would be working on a net margin of kind of 35%. So That was great. I find that really, really clear. I hope everyone else did.
Listen, it'd be great to know what people are
Yeah.
thinking, because I try to make it relevant, but these are very big subjects. So yeah, if there's any questions or comments, I'd be happy to take them.
Thank you very much. Thank you very much.
Okay, well, thank you.
So I suppose the silence is telling. Does anybody have any clarification or detail that they'd like to ask? With these things as well, if anybody wants to contact me afterwards to get in touch with Florence, because sometimes, when you're thinking about it, it's not like if you're studying branding or packaging, the questions may be less immediate. You may need to go off and look at the material.
And you'll need to, take your Excel spreadsheets or start styling things up and seeing, it's really when you put it in practice that it comes up and the questions come up. And that's why I wanted an example, so that it actually related to real activity. But, feel free to contact me on Instagram, to LinkedIn if there's any questions coming up. As I said, I'm not a tax accountant, but really coming from a business management point of view, it's great to, it's great to talk about it, basically.
Exactly.
And for people to really understand that, by knowing the subject better, you can actually have a choice in how the decisions you may take and how they affect how much, at the end of the day, for me, the most important thing is how much you pay yourself.
My stalwart attender, who's really good at giving me positive and constructive, is that what you call it, feedback, is commending you once again on an excellent presentation. And this is really good. Mary's saying, it makes her want to go back and look at her own numbers, and now she can see the relevance of looking back to forecast. That's really good. I'm going to give you this one. What if you're renting products? Perhaps I should send this to you for advice. Okay, that's what we'll do. I'm going to connect you with this person afterwards, I think is the best for that. So listen, that was a very comprehensive whistle-stop tour. And I'd just like to thank everybody for being with us today. And Florence, thank you again.
Well, thank you.
Thank you very much. Thank you, everyone. Bye-bye today. Bye-bye.